Hello, everyone, and welcome to the Good Morning Trading for Monday, June 8th, in the year of our Lord 2026, where a trader speaks to traders. On Friday evening, Wall Street experienced the most violent session of the year. The Nasdaq plunged by nearly 5%. That's the closing figure. And at minus 4.18%, it was its worst day since April 2025. Nearly $1 trillion evaporated into thin air just from AI stocks alone. This morning, the shockwave hit Asia, especially South Korea, which took a major hit and triggered a circuit breaker. For those who don't know, a circuit breaker is when prices drop too much. They simply shut down the stock exchange, disconnect the computers so people can't trade live, giving everyone a chance to regain their composure. The Kospi index, which is the Korean index, had lost nearly 8% right at the open, so they decided to pull the plug. Samsung was down 10% as soon as trading started. So the big debate is back. Is the AI frenzy over? Are we facing a bubble that's about to burst? So stay focused and keep listening until the end of this show, because during the anecdote of the day, I'll tell you about a discreet army of Japanese retail traders who, for nearly 30 years, have been shaking up the currency market. We're going to see what that's all about. So we have three key issues that will set the pace for our session. The fate of semiconductors and AI. The yen, which is hanging by a thread after the shock in Korea, and I'll explain all that to you in detail. And the U.S. inflation data coming out on Wednesday. All right, let's quickly take a look around the markets. So, as you know, Wall Street on Friday night. The session was more than rough. The Nasdaq ended down 4.18%, the S&P 500 lost almost 3%, and only the Dow Jones held up, losing just 1.35%. Why? The trigger for this drop isn't fear about demand, for example. Quite the opposite. It's that the U.S. job market is way too strong. The stock market started to fall because we got excellent economic news. In the United States, unemployment is going down, and they're creating more and more jobs at a very strong pace. So why does that make stock prices go down? And especially artificial intelligence. Quite simply, if unemployment is going down and there's a huge demand for job creation, you get competition. It's supply and demand. That means you'll have to pay your employees a lot more to keep them with you or to attract new ones. So when you're at Walmart, for example, and you're a big retailer, you're going to have to raise wages a bit. Your employees, the ones who are underpaid, you'll give them a $1 raise. They'll be happy and it won't cost you much. But in artificial intelligence, when you have to give a raise to a specialized AI engineer at Google, Anthropic, or ChatGPT, we're talking about millions of dollars in salary increases. To be able to keep the guy, we're talking about salaries at 10, 12, 15, even $20 million. You give him a small raise, just 5%, and right away, that's an extra $500,000, $1 million, $2 million. And that's why there was a huge profit taking. It was a bit heavy-handed, but it doesn't call all of artificial intelligence into question. It doesn't call anything into question at all. It's actually because it's working too well. And so, if they have to give their engineers really big raises, their profit margins will shrink. They're going to make a little less money. So this fear spread throughout Asia. The Nikkei lost nearly 4% last night. So once again, it's the tech stocks that took a big hit. I mentioned Korea to you, and as for the other indexes, they're doing more or less okay. China's holding up well, down 1.5%, and Australia's down 0.7%. And the U.S. futures are trying to bounce back, so as you can see, the situation isn't. We're definitely not in an end-of-the-world situation, and we'll look at why. Now let's move on to technical analysis. So I haven't fully optimized all my analysis software yet and artificial intelligence tools, but normally I've set it up so that when I say the words technical analysis, it automatically switches to the chart without me having to do anything. Well, that should be ready within a week, I think. So technical analysis, let's go. I'm on my favorite, the Nasdaq. So Friday's drop, pretty standard. Now, just to be clear, we lost a little over 4% on the Nasdaq. On social media, it's total panic, end of the world, and so on. Well, so I base my analysis on two things. Either they know absolutely nothing, and I'm starting to believe that 90% of people on social media know absolutely nothing about the stock market, or they have less than 6 months of experience, like a rookie. When I started out myself, 20 years ago, with Nasdaq futures, a daily swing of plus or minus 3% was totally normal. Contrary to what people think, the Nasdaq is becoming less and less volatile. So for an old hand like me, a 4% drop is just another day. It's far from panic mode, especially since everything worked out fine. We bounced nicely off the monthly pivot, we bounced off the monthly S1 middle, and just an hour ago it bounced again and gained back over 1%, nearly 2%, almost 300 points. So the old methods, if I may say so, still work just as well. I was able to talk about this with my students in the Good Morning Trading Premium. Now, I do the Good Morning Trading Premium at 8 a.m., and you'll get the regular Good Morning Trading Lite version on YouTube around 8:30. So, about half an hour later, roughly speaking, priority goes to my students, so nothing special there. And we're holding up well. Just to take a little step back, for the past 2 months, we've been climbing nonstop, going from 23,000 to 31,000 points. Basically, over the past 2 months, in a straight line, we've gained 33% on the Nasdaq. No one was worried about it. It's completely normal. When it goes up 33% in 2 months, that's totally normal. But when it drops 4% in a single day, everyone panics. All right, let's all take a deep breath. Not to say something a bit more vulgar. We just made progress over the past 2 months. What's more, 25%. So we're still very, very much in the green. If this little drop scared you, it means your money management isn't right. It means you're not ready for a real trading day. A real black day on the markets. So don't panic. In Korea, we saw that things started to get a little panicky. They triggered the circuit breakers. That doesn't mean we couldn't have another day at minus 5%. Honestly, nobody knows right now. No one can predict the future. I'm sorry, I know I'm not very popular with fortune tellers, both male and female. But to this day, in 50 million years of human history, no one has ever been able to accurately predict what would happen the next morning. The only thing we can manage to predict the only thing we can more or less predict is the weather, but as for the rest, absolutely nothing. There are still some steps to take before we get there, and we'll try to live another 50 million years, even though I doubt it, especially when it comes to rebounds. Look, it's bouncing back, but we're still in a waiting phase. So what do? How do we handle these kinds of situations? Well, we wait. We wait until we reach levels we've identified in advance as extremely strong, like a pivot point, like a weekly pivot point. And we do exactly the same job as usual. That's the great advantage of scalping. If the markets panic, we get our day done. If the markets are sluggish, we get our day done. We make about the same number of points, and that's it. And we don't care. We don't have a swing portfolio that just took a hit of minus 5 or minus 10%, and now we don't know what to do. That's all. We get in, we get out a minute later, 2 minutes later, 3 minutes later. Thank you, goodbye, and we let everyone else run around like crazy. So there you go. If you want to get into a style of trading that works like this, where you sleep well every night, where you trade for 1 to 2 hours a day at most, think about scalping. You get results right away. You don't have to wait. That's why I think I'm a hyperactive person, so that's why I like it, scalping. I get in, I wait maybe a few seconds, a minute, and I know if I've won or lost. And then you move on, and you move on. You're not dwelling on it, feeling down, or worrying about your portfolio, and so on. Tomorrow, it could drop by 10%, and you're still happy. Tomorrow, it could go up 10%, and you're happy. Scalpers are people who are always happy. All they want is for the market to be open. That's the only thing we ask for, and for the past 200 years, it's been pretty much open for about 150 years, or 140 years. Sorry, it's been open regularly, so for us, everything's fine. Nasdaq had made a little rebound. I'll quickly go over the American markets for you. Same thing, stabilized. Let me put a monthly chart on the S&P. 500, it's clean. We have monthly support that could come in to help us if we keep going down. And the one that dropped the least, which is still at its lowest for the past 15 days, is the Dow Jones, because it's less affected by an extremely strong U.S. job market. On the European indices, the drop is very slight. In the end, it's down only 0.76% on the CAC 40. We're almost at a 2-month high. So, yeah, things are going well. Of course, unfortunately, the CAC 40 isn't really affected by artificial intelligence because it doesn't have any AI companies, so it doesn't have much impact from that. On the other hand, the DAX is just a little more affected because it does have some. They're not AI companies, they're software companies, and they can be affected. Them too, because their best engineers are getting poached a bit by the Americans. Right now, there's a race for brain power. That's what drives artificial intelligence and allows things to accelerate. But you still need humans to guide and manage all of this. And now, in the software sector, some are apparently struggling because artificial intelligence could pretty easily replace solutions they're selling for $10,000 a year. And if, for a $200 subscription and a few well-crafted scripts, you can do the same thing, well, you're not going to spend $10,000 unless you're taking bribes, but that's another story. I was talking about this one day. It was pretty funny. I worked for an international group where they paid for their computers. They bought 10,000 computers. I won't say which brand. And they paid more for them than I did when I bought just one as a private individual. ... A classic, really. So as for the DAX, though, midday of the monthly trial, it's bouncing back nicely. All right, let's go. On gold, well, listen, nothing's changing with gold. It's going down. That's it. We're used to it. Gold's been dropping for 2 months. It keeps going, and it's even picking up speed, even now. So, gold has taken another hit again. A good little slap. I've been telling you for several weeks now, it's not something to buy. Well, listen, that's it. It's not something to buy. You can give back the gold ring you swiped from Aunt Janine. It's not worth anything anymore. Now let's look at Bitcoin. Well, listen, it's the same story. For a month now, it's been dropping. It's lost $13,000. Sorry, $20,000. It's lost a quarter of its value. Well, it's still worth something. There are still people who believe in it. It's like a Dutch tulip that just takes a long time to deflate, because behind it you have the hope of the middle class getting rich without doing anything. They hope that one day they'll wake up in the morning and Bitcoin will be worth $1 million. Because that's what they've been told for months, for years. Yeah, well, the day you get paid in Bitcoins, we'll talk about it again. The day you buy your house with Bitcoin, we'll talk about it. And the day you go grocery shopping at a big supermarket with Bitcoins, we'll talk about it again. For now, it's something. It's a concept that's also open source. So there you have it. Out of the $62 in 1975, what is the actual value of Bitcoin? You have about $62,500 of pure speculation. And then, of course, we have our little oil price, which is going to go up, especially since this morning Iran fired salvos of missiles at Israel. We're waiting for Donald Trump's reaction, but honestly, we're used to it by now. Now, just sending a missile makes the price of a barrel of oil go up by a few dollars. If this had happened 10 years ago, oil would be at $120 or $130 a barrel. Now we're even below $100. You see, there's no reason to panic. Now I'm looking for the button. It's not that one. It's this one. There we go. So I wanted to talk to you about today's barometer. Today's barometer is the yen and the big carry trade game. Listen closely, you might be about to learn a lot. The yen is currently hovering around 160 yen to the dollar. That's about the intervention threshold, the level that wakes up the Tokyo authorities. The Bank of Japan is going to meet. So, I forgot the exact date. It's in about 10 days, but it's going to be interesting to watch. So, the principle's pretty simple and has been for over 20, even 30 years. You borrow yen where the interest rate is very low, so you can buy yen cheaply. So you borrow yen and invest it somewhere that pays a bit more interest. So I'm going to totally simplify it. You buy yen on credit at, these aren't the exact numbers, but you'll get the idea. At 1%, let's say, and you deposit it in an account. You move it to the United States, for example, into treasury bonds at 4%, and you make 3% without doing anything. This has been working for nearly 30 years, more or less. So you buy yen, you borrow yen to buy something that pays a little better, and it works out great. You go see your banker, you borrow at 2%, and you lend to someone at 4%. There you go. It's easy. You make money. But then we had a home run in Seoul. Ho, ho, ho! That could be the spark that lights the fuse. Remember one thing. Yesterday, in August 2024, just a small move, this Japanese action made the Nikkei drop by 12% in a single session. The Bank of Japan had slightly raised its rate, and the Nikkei plunged by 12%. Be very careful. If the value of the yen really takes off, it's going to trigger a whole domino effect that could potentially change everything. That could collapse. Quite simply. Quite simply. All right. That means there will be a lot less liquidity. There will be far fewer people borrowing in yen to lend elsewhere. Because it won't be worth it anymore. It'll become a bit risky. That was the thing. It was kind of like two risk-free investments. But if the yen rises too much, the whole system just doesn't work anymore. That's why people say the yen is still the canary in the coal mine for global liquidity. It's a key factor, but also a source of fragility. So the big topic, the topic of the day. The big topic is artificial intelligence after Friday's earthquake. At the heart of the debate, actually, we have NVIDIA, whose value is nearing $5 trillion. Any disappointment is no longer forgiven, and on Friday the stock dropped 6%. 6% of $5 trillion. If you do the math quickly, that's a lot. That's $300 billion that just evaporated for NVIDIA alone. However, the big banks remain extremely positive. I looked at the latest analyses. Morgan Stanley still sees NVIDIA around $250, which means more than 20% upside potential. And we have a major American bank. NVIDIA is its favorite stock. They're targeting $275, and in their latest statement this weekend, they said the current pressure, the drop in any case, is relatively temporary because demand is extremely strong. So our scenario also basically comes down to two things: moderate inflation, and on Wednesday we'll get the U.S. inflation numbers, which are expected to be moderate. This means that interest rates shouldn't have to go up. Then good results from Oracle on Wednesday evening. That would be the ideal scenario, confirming the appetite for everything related to artificial intelligence in the cloud. This could turn the recent drop into a buy-in opportunity. So that's on Wednesday. I think it's all going to hinge on Oracle's results and the inflation numbers. That's the ultra-positive scenario. The negative scenario, the bearish scenario, is the opposite. If inflation has risen in the United States, then interest rates are likely to go up. And that's really bad news for all the AI companies. We have already seen this exact scenario happen before, and if Oracle's upcoming financial results aren't particularly great, we could very well see the Federal Reserve begin to tighten things up, and a massive $5 trillion company like this, like NVIDIA, which has to borrow money, any change in interest rates costs them billions. So today we're having a macroeconomic session. I'm a little slow today. Today, well, I'm going to try to be a bit quicker. I have so much to tell you, and I'm tired. Also, my delivery isn't great. Not my internet speed, I mean my speaking speed, just to be clear. I see some of you have your minds in the gutter, so just to clarify, today we have a macroeconomic session that's pretty calm. Wednesday is when things are going to get important, and I'm wondering if the market for the next 48 hours, Monday, Tuesday, and part of Wednesday, won't just be waiting. It's these statistics that will tell us whether they're going to start buying up everything related to AI, or if, on the contrary, they're going to be even more cautious. At this point, there hasn't really been any loss of money. It went up by 30%, then dropped by 4%. So they've made a lot of money, a huge amount of money. The only question now is whether they're going to cash out right away. Or are they trying to get a little bit more, thinking, well, if it bounces back, it would be great if I still had a lot of shares. We'll see. Anyway, like I said, I think the key moment is Wednesday. If you want to learn a lot about the stock market and spend a week with me, and we're going to trade live, so don't hesitate to come to my seminar. In Andorra, which takes place from July 5th to 12th, there are 3 spots left, and from the 12th to the 19th, and now I think at this point there's only 1 spot left after that. You'll have to wait, because the next one will be in Canada in we're in 26, so 2027 in Canada, 2028 in the United States, and 2029. If all goes well, in Japan in 2030, it'll be Venice. So, to get back closer to France and Belgium, the next seminar will probably be in about 4 years. All right, let's wrap up. So, fear suddenly woke up again after 2 months of complacency. It just kept going up. It's kind of crazy, honestly. An index that gains 30% in a month, you don't see that every day either. So, let's respect the indices. Let's keep our cool and avoid acting in a rush. The real test isn't today's session or even tomorrow's. It's the one about inflation. Wednesday is when we'll really be able to make decisions. And in the meantime, we can scalp calmly at key levels. And very importantly, I think, the common thread, if I may say so, is the yen. We need to keep an eye on it around 160 yen to the dollar. As long as it holds, we're good. The issue remains limited to technology, if I can put it that way. If the yen soars, there could be a global liquidity problem. We'll see. We've still got time for that, at least 48 hours. So, you remember I told you about a discrete army, just as a little anecdote? Well, at the end of the 1990s, The Economist magazine coined the term Madame Watanabe, which refers to the crowd. These small Japanese retail investors who, after the bubble burst, put their household money into the currency markets. In 2007, these so-called slipper traders, who were a bit older, accounted for nearly 30% of the currency trading volume in Tokyo. To the point that a Japanese central bank official, jokingly, but still quite seriously, because the Japanese are always serious even when they joke, said that where the gnomes of Zurich once destabilized financial markets, the housewives of Tokyo now stabilize them. So that was still the case 10, 15, 20 years ago. Today, Madame Watanabe is still around. Her portfolio's a bit shaky, she has less liquidity. And her child doesn't do what she does. He blows his money buying Bitcoin, hoping to become a millionaire in 24 hours. A generational shift. But remember this, when you hear about Madame Watanabe, now you'll know what it means. Thank you for sharing this moment with me. It's been a real pleasure. And starting tomorrow, if you're curious, I'll open up my world to you. You already know a YouTube channel, this one, the trading channel, but I'm also going to introduce you to new channels, one for economics, history, psychology, and news, everything I love. And we'll have 2 daily meetups, the Good Morning Trading, in the morning, and in the evening we'll have a Hall Events recap to take a step back from the news. I'll give you the links tomorrow so you can subscribe. So I've separated the different worlds because since people can be stupid, you always have to keep in mind that people can be stupid. When I made history videos on my trading channel, I had just people complaining. Well, there you go. If you don't like history, don't watch it then. And on my history channel, there's no problem. If you don't like psychology, don't bother subscribing to the psychology channel. Don't worry, you'll stay in your own little lane. So trading, economics, history, psychology, and news. That should do it. The news is pretty packed. 5 channels, 2 daily shows. Just one habit to pick up. Subscribe and always stay curious. That's a hunger jingle right there. I worked on it. I think it's lame, but I couldn't come up with anything better. All right, sending you my best. See you tomorrow, and you'll get the links to subscribe. Then you'll get the first videos on history, economics, and psychology. And then on the news front, sending you my best. Ciao.